Today, we want to discuss the top 5 trends of the past month. And as so many of you may be aware, we actually had the Ethereum Community Conference in Paris over the past couple of weeks, and a lot of really great, important, and industry-defining upgrades and announcements were made over the past 2 weeks. So Karim and Nina are going to unpack some of the things that we've seen. As you guys know, or may not know, Karim and Nina are part of the research team. And today we're going to unpack the top 5 trends. So we're going to get started with Karim. And before we get started with Karim, let me give you guys the top 5 trends that we're going to discuss. So number 1, we're going to discuss about the significant user experiences improvements from some of the announcements that we've seen on the Ethereum Community Conference. Number 2 would be the bugs and the vulnerabilities and how they can be solved with some of the solutions that came out. Number 3 is going to be about how blockchains connect with one another and some of the new primitives and use cases that we see in the market. Number 3, the market impact of the Ripple case, should I say actually number 4. And number 5, last but certainly not least, we're going to talk about tokenization with public blockchains and discussing about some of these new frameworks and reports that came out lately. Karim, let's start with the significant user experiences improvements that are going to help with mainstream adoption in crypto. And that's really important for the investors to really keep an eye on some of these, I would say, dots that connect with one another to get to a better user experience, the same way we've seen with the internet, the rise of antiviruses, the rise of secure internet protocols like HTTPS to get to a better experience over the internet. And we're seeing the same thing as well with crypto. So Karim, can you try to unpack some of these new primitives and use cases like account abstraction, scaling solutions, the Dencun Upgrade upcoming for Ethereum? Tell us more about it.
Absolutely. Okay, so let's take a quick step back. So when we think about account abstraction, is simply a mechanism that essentially makes your user wallet a little bit smarter without getting into the technical details. There are mainly 2 types of wallets. There are EOAs, which without getting into the jargon of it, it's user wallets, or there are wallets that are pertaining to smart contracts. So think of it as when you deposit money into a protocol, where does this money go to? There has to be a wallet. The only difference is that with applications, they're a bit smarter because they know what type of consequent actions that the application can take. Yeah, that's essentially what account abstraction is. So the feature or the technology itself, it was actually introduced to the Ethereum network a couple of months ago. It did not modify the main Ethereum network. However, it just introduced a new layer of, I would say, options that could improve your user experience. So what are some of the things that it can do? Think of that. When you are paying for transactions on Ethereum, you need to pay with ETH. However, with account abstraction, since you have a smarter wallet, you could essentially be paying with USDC because in the back end, this conversion happens automatically. And this is a huge barrier of entry for users because at the end of the day, not most of them know that you need to have the native token of the blockchain that you're transacting on. Another thing, if you lose your private key to your wallet at the moment, your wallet is gone, your capital is gone. However, if you from Web 2 and traditional databases, you know that there's something called a recovery. It's not the end of the day if you lose a specific piece of your credentials. With account abstraction, you would be able to think of it as a login key on your Telegram, on your WhatsApp, or your email, so that if you lose one bit, you don't lose everything. So yeah, that's just 2 of the most, I would say, intuitive features that account abstraction could introduce. And that's what Vitalik was essentially very excited about in the ETH conference. So account abstraction, again, it's not new, but what was missing is a general direction and a general push from the Ethereum developers community to start prioritizing this, because this is really a huge barrier for people who are just not tech savvy enough with crypto, or really for anyone who's just entering the space.
Having to worry about having exposure to, for example, ETH to pay transaction fees, or trying to worry as well, unfortunately, about the password, PIN code, or in the crypto language, private keys. So some of these applications that we're seeing today that actually leverage this new technology, there is, for example, Argent, so ARGENT, like basically money in French, that basically allow people to leverage that technology without even like realizing that they're using that technology specifically. And I think the first, I would say, Trojan horse for this technology, or actually the applications that we are using on a day-to-day basis, like Instagram, like WhatsApp, but basically crypto native on our phones, that actually leverage that specific piece of Ethereum. And that's something that we could see as well over blockchains, right? Kareem, we could see that on Bitcoin, we could see that on over layer ones. And I think that's something that is really exciting. And I think that would definitely be one of the key building blocks to get to mainstream adoption. The other one is scaling solutions and the Dencun Upgrade, right? Yeah, I think both of them are going hand in hand. Kareem, tell us more about what you've seen so far with scaling solutions.
It's quite funny when you remember just a year ago how we've had so many competitors for Ethereum. Everyone was betting on the fact that they would have their own network effects, but we're really seeing a complete deviation away from this. Right now, we're seeing a lot of projects either pivot back into becoming a scaling solution for Ethereum, or in other cases, they are essentially trying to provide a framework to create customizable networks. So what do I mean by that? Think of this. If you have a social application, you don't need the same security guarantees as a financial applications. With social or with gaming, you don't really need that much complexity. So if you do have a network that is tailor-made for your specific business needs, then this would be a huge push for the throughput and for the performance of the underlying networks. And that's essentially what we saw. So there's, generally speaking, two stacks of scaling solutions. There's optimistic rollups, and then there's zero-knowledge rollups. Optimistic rollups, it requires more guarantees of trust. With zero-knowledge proofs, it doesn't really require that because it's all based on math. And the point of this is that they're not just scaling solutions on their own. They now have a framework. Essentially, most of the scaling solutions now provide a framework for applications who want to pivot from just being an application to being a standalone network that is anchored to the security of Ethereum. Because ultimately, that's where the liquidity is, that's where the users are, and that's where the volume is. And the first example that we saw of this is Base. Coinbase decided to launch their own scaling solution on top of Optimism using their OP stack. So OP stack, again, is the framework that allows applications to build their own customizable networks. We've already seen
very similar to basically like an operating system, if you want to have an analogy, right? For example, Twitter leveraging the iOS to launch the Twitter app, or now actually X, right? Having another application like Instagram using the Android operating system. And some of these interconnected blockchains on top of Ethereum or compatible with Ethereum, like Optimism or Arbitrum, or in that case, also zk-Sync, do have their own operating system that others, like over entrepreneurs, developers, can actually launch on top. And one of the things that is super exciting about is how this is going to unleash a new wave of like narratives that is going to be completely different from the last bull market, right? As you mentioned, Kareem, like in the last bull market, we had actually the narrative of like alternative Ethereum blockchains or alternative layer ones. And now we're seeing that there is an alternative for layer twos or scaling solutions. And some of them are trying to basically be the base layer or the operating system or the standard of operating systems for layer twos to enable any entrepreneurs to build on top. Instead of building directly on Ethereum, they would build basically on their own base layer. So tell us more about the OP stacks and what you see so far.
Just as a recap, OP stack, it's just a framework that allows any aspiring application to launch their application without bootstrapping the whole developmental process from the beginning. So think of it as plug and play solutions to a certain extent, that you would not need to configure the entirety of your network. You just need to configure certain parameters. And based on that, you have your solution being fully deployed. Using OP stack, we've seen a lot of projects announcing either their intent to launch on OP stack or they have launched already. WorldCoin is another example from a few weeks ago, the digital identity application. We also saw Anderson Horowitz. They're launching their own application on top of Optimism. So all of this really just highlights the benefits of having a customizable network where you can change the permissions, modify the permissions, how easily people can join and leave the network, what type of gas fees they can pay, and a lot more. But just to keep it condensed, that's essentially the excitement around OP Stack. And we saw that we have 4 frameworks right now. So this is a serious trend that we will be absolutely monitoring moving forward. Because again, we also spoke about application-specific blockchains last year. This is the iteration of it, but rather than just a standalone blockchain, you now have this anchored to Ethereum.
And you know what? I don't know if you knew Kareem or Lina, but there are also layer twos on Bitcoin. There is one that is very similarly called like ZK Sync, but for Bitcoin called Zero Sync, that actually allow any entrepreneurs to build on top of Bitcoin. But the thing is, they need to change the code base of Bitcoin to make it compatible for layer twos. And that's something that is under works. But we're seeing as well that this concept of scaling blockchains to thousands of transactions per second instead of a handful of them is one of the biggest trends that we're going to see for the next few years. And definitely Ethereum has a head start compared to Bitcoin and any other smart contract alternatives. Tell us more about what's coming up next for Ethereum with the Dencun upgrade.
Of course. So this is going to really provide a lot of benefits and improvements to the Ethereum network as an underlying settlement layer. Most importantly, because there's really a lot of things that it will introduce, but the core feature that will be implemented is essentially introducing this new concept of blobs of data. So what does that mean? Think of it as that. Ethereum, that's the base layer. Any of the scaling solutions, they come on top. In order for all the scaling solutions to prove that the work that they are submitting to Ethereum is correct, they need to access data on Ethereum. Right now, this is not as easily as accessible. And it's not quite fast because there is vast amounts of data on Ethereum that L2s or scaling solutions have to query in order to understand the real estate. With blobs of data, it's just going to be subsets which allow those scaling solutions to verify the authenticity and the validity of their data and have it in much cheaper transaction fees as well. And that's just the top line of the new improvements. Storing data on chain is going to be cheaper. There's going to be more standardized designs for bridges, which is a huge thing that crypto has been missing so far. We're really missing on a lot of standardization across many things, but at least we started off with the taxonomy of how to classify crypto assets. But this is really a serious gap that needs to be filled in. And that's for Ethereum. Yeah.
Absolutely. And so the first point was user experiences, and the second one is cybersecurity when it comes to bugs and vulnerabilities. What are currently the issues that we've seen so far in crypto, especially in DeFi? Recently, we've seen that Curve had an exploitation or vulnerability that was found by some of these black hats or hackers. Tell us more about what happened with Curve and what are also the solutions amongst these specific section in crypto, which is cybersecurity, and how also some of the bugs that we've seen in the past with bridges are coming finally to a conclusion and a solution when it comes to what Chainlink announced also 2 weeks ago.
Don't spoil the surprise.
I don't want to spoil the surprise, but I have to give some indication to the audience.
Absolutely. Okay, so starting off, Curve is one of the largest DEXs or decentralized exchanges in the crypto market. So they have one of the most liquid and one of the highest volume generating exchanges across crypto. It's mainly focused on stable coin swaps, but since they have a really efficient mechanism to create an efficient conversion system, but it extends beyond that. So what happened essentially over a few days ago was that there are two programming languages that are used to build applications on Ethereum. There's either Solidity, that's the native language that's been around since Ethereum was a thing, and then there is Viper. Viper is essentially a derivative of the Python programming language that is supposed to be replicating the same sort of logic and functionalities of Solidity. Obviously, the benefit of this is that Python is not a crypto native language. It appeals to everyone. So this obviously helps onboard developers that are not just interested in the crypto ecosystem or the blockchain technology. So what happened with Viper is that there were very specific versions of Viper. I wrote them down here. It's 0.215. 0.216, but without getting into those details, they essentially had an error in how they processed a specific function. That function is called a re-entrancy attack. We're not going to get into the jargon of it, but in very simple terms, think of this. If you have a banking application and you have $100, you went in, you tried to withdraw $80 the first time, and then essentially you should have 20. The problem with the re-entrancy attack is that if you are now using a crypto wallet, so you initiated a withdrawal of $80, and then rather than waiting, you executed the same function again. So the error here is that the programming language does not process or does not validate the sanity of consequent actions.
Yep.
So essentially that means that if a user just withdraw $80, he would be able to call that function again and withdraw another $80, even though the total amount that he has is just 100. And that's essentially what the error was with Viper. It's worth noting that this does not affect the entirety of Viper. And most importantly, that the newer versions of Viper itself was fixed. So this is not something to be worried about right now. But for the context of what happened, there were 5 pools on the Curve DEX that were affected because they were the ones who were developed by this specific version of Viper. And essentially, this led to the exploitation of those pools. The hacker that we still don't know his identity, he was able to siphon, I think, around 26 or 27 million, if I remember the figures correctly. And yeah, that was really it. So just for the broader implications on how this is affecting DeFi. First of all, there's the Curve founder. He has taken a bunch of loans using Curve as a collateral in order to finance his business operations or his real life expenses. And just to, as Ellie is correctly showing here, he has $18 million worth of hacked assets. So to continue on the broader implications, since Curve's founder is taking loans on DeFi, which is on open financial systems, everyone in DeFi right now is aware of the positions that he has on the 3 largest lending protocols, which is Aave, Curve, and Frax. So because of the fact that his position is quite known and the liquidation level is quite known, there has been some activity of people trying to force him into a position where he liquidates his assets. Now, back to the hacker, the assets that he has in terms of Curve, they do not constitute that huge percentage. However, if he does sell it, it will only just affect the value itself of Curve, not by much, but it would cause a cascade of liquidations, since this will trigger the Curve founder's loan, essentially, trigger the liquidation of his loan. And that's what worried people, that essentially that DeFi applications can potentially accrue bad debt. That's number one. Number two, for just the everyday user who used Curve as a collateral, their positions might also be at risk. Curve's founder has been taking a bunch of good steps to rectify the situation. It's not confirmed yet, but it was reported that he has been initiating OTC trades, essentially to avoid selling Curve and to reduce the market impact of this increased supply. And he's really been doing this over the past 24 hours. So that's as far as the Curve story goes. Of course, we will be monitoring.
There's also, Karim, very important to note that the price of Curve was, of course, affected as well. The token itself, when it dropped by more than, I believe, 20% within 24 hours. But there is a specific level of the price. The price is around 60 cents today, but I think around 42 cents. This is when we see significant amount of liquidation. So that's something we need to keep in mind. And of course, the audience, if you sign up for our newsletter, you're going to have the up-to-date insights into what's going on behind the scenes.
Absolutely.
All right.
But I think it's really worth quickly highlighting something. If this was November in 2022, or if this was July of 2022, where we could have seen some individuals who did not take proper risk management, if they were in this position, the traditional financial structure would have gave preferential treatment towards this very large player, since essentially he's a large player, he contributes to the ecosystem, so you really don't want to impact him. Now, when we talk about native blockchain infrastructure, it does not care who that person in question is. All it cares about is math. If you have enough collateral and enough capital to cover your expenses, you're good. If you're not, it does not differentiate or determine who you are, and based on that, it can change its actions. So it's really worth highlighting this compared to the previous issues that we saw in centralized finance or even in TradFi.
Yeah, couldn't agree more. Let's move on to some of the solutions that we could see with bridges from Chainlink's announcement.
Absolutely. So I was really excited to get into the details of this, but I will leave this as a surprise. If you guys really want to learn more, do check out our newsletter. It will have more comprehensive just breakdown. But essentially, yeah, just as a very quick recap. So with bridges are essentially the tools that help you to transfer a native asset from one blockchain to the other. They have been the prime target for hackers since we saw almost more than $2.6 billion worth of assets that were hacked and siphoned out of bridges. So there are plenty of issues with bridges to begin with. However, Chainlink CCIP, I'm not going to talk about the different components of what makes CCIP, but specifically the features that help address the shortcomings that we saw in traditional bridges. Okay, so very quickly, what is CCIP? It stands for Cross-Chain Interoperability Protocol. It's not a bridge and it's not a software. It is a messaging standard. Same way that for the non-techie users, the internet, as we know it, it works using things that are called TCP and IP. These are essentially, think of it as web mechanisms that help aggregate all of this information and gives it to you in this uniform display that you see in front of you when you use a browser. So with TCP, it's essentially creating a messaging standards between all the blockchains that Chainlink will support. So what are the distinctive features that help it stand out? 4 things. 1, there's something called a programmable transfer. So what are programmable transfers? That is essentially a way to automatically execute predefined conditions once they are met. So think of this. You have some money on Ethereum, you want to take it to Avalanche. But after you take it to Avalanche, you want to deposit it into a lending application. And then once your rewards have met a certain threshold, you want to take this capital back. You can do all of that in one go, programmable transfers. 2, and these are the kind of things that address the security issues, something like as a rate limit. So what does a rate limit mean? You have 10,000 tokens in your original chain, and you essentially want to establish a maximum cap size. So essentially, if there are more tokens, more than the designated 10,000, the bridge or the messaging standard that the bridge is built on would essentially pause this activity because you have a maximum amount of tokens that you can transfer. You also have smart execution. Smart execution is more focused on the user intuitiveness rather than, so in the example of having to do multiple transactions and multiple activities on multiple blockchains, rather than having to pay for all of those, you essentially could pre-fund your account and you could instruct your wallet to pay for all of these in the back end. This would essentially abstract away the complexity of just having to pay over and over again. So programmable token transfers. And then the actual solution that helps address all of that, which is Active Risk Management Network, the ARM network. So for the bridges that we have been used to, it's simply just a solution that receives a bunch of instructions and then it just executes it automatically. There is no sort of a secondary validation service. There are no third parties that are essentially just exist to make sure that transactions are happening as they are intended. So with ARM network, we now have 2 additional supervisory networks. Before we get into this, let me just emphasize something real quick. The entirety of the Chainlink network operates on something called DONs, decentralized Oracle networks. Think of this as a bunch of Bitcoin miners or a bunch of Ethereum validators that form a committee, and then this committee essentially serves a specific function. These are the DONs that help with transferring the data from one blockchain to the other. It offers the price feeds and all of that stuff. However, with ARM, you now have 2 additional DON networks. One simply lives off-chain and one lives on-chain. The on-chain ARM network, there is one that exists on every blockchain that Chainlink will support. And its entire use case is essentially to do 2 things, either to bless or to curse the transaction that is being initiated. And the way they do this is that they work in collaboration with the off-chain ARM network, which essentially lives to do just one thing. If you have an order of transactions of A, B, C, the off-chain ARM network essentially reconstructs the history of transactions to make sure that things happened in that very specific order in ABC. If that doesn't match, then there's essentially something off here. And based on that, it is able to hold and pause any malicious activity if it does detect one. And this is really something that we have not seen any sort of close resemblance with the current bridging models. So this is beyond exciting to see this as a security feature to help protect users. So why is this exciting? Think of this as cross-chain lending. If you have some assets on one blockchain and you want to essentially supply it on a different blockchain, Now you're able to do this without having to rely on a bunch of multiple third parties and essentially having to trust them to get your assets to be transferred. And yeah, that's just one of the simple examples. If you have a gaming application on Solana, you would want it on Solana because of the high performance. However, if there is something that requires higher security guarantees, in that case, you are able to create a multi-chain smart contract where the gaming aspect happens on Solana, while the settlement of whatever type of financial transaction takes place happens on Ethereum. And all of that happens in the back end so that you as a user, you don't need to be aware of bridges or any of that, technicalities really. This is just the tip of the iceberg. There's so much more to discuss about CCIP. So look out for our monthly review.
This is a great summary of CCIP, and I think that's analogous to some of the things that we've seen 8 years ago when Ethereum came out with a yellow paper to mention about the possibilities of smart contracts. And by the way, Ethereum turned 8 years old 2 days ago. And CCIP is like one of these new technologies that, as you can see, Karim is extremely excited about. And there's a lot of potential as well beyond security practices in crypto that CCIP can solve as well when it comes to, for example, interoperability, right? As you guys know, blockchains are pretty living in silos and not connected with one another. Bitcoin and Ethereum is very hard actually without intermediaries to transfer assets from one blockchain to the other. And that's exactly what CCIP to some extent also solves amongst other protocols that exist out there. This is not financial advice, but there is like Polkadot, there is Cosmos, and there's also like this concept of scaling solutions being interconnected with one another. Last point, tell us more about how CCIP is going to solve that issue with interoperability, and whether do you think that protocol could become the standard down the line compared to, for example, Cosmos IBC?
Absolutely. I've had a lot of different opinions on how CCIP will fare with IBC, but as I've learned quite recently, so IBC, for anyone who doesn't know, that's the technology for the Cosmos blockchain. It's called inter-blockchain communication, and it's essentially how assets are transferred from one network to the other. So if I were to be comparing both, IBC still requires some work in order to be extrapolated beyond the boundaries of Cosmos. Because at the end of the day, we have to remember something. For two blockchains to interact with each other, they need to understand each other's securities parameters. So with IBC, it still requires that it goes beyond the consensus system or the consensus algorithm of Cosmos. It needs to be compatible with other technologies. With CCIP, it's quite different. It's blockchain agnostic, meaning that whatever network that the foundation decides to support, they will launch the tooling and all of the relevant, essentially, software development kits that helps this. But with regards to how it could solve the issues that we've seen with bridges, I think two of the features that I've mentioned really highlight this. If you put a cap side on the amount of tokens that can leave from your application on Ethereum to the other network, in case someone does gain unauthorized access to your application, those tokens will not be transferred out because they are configured programmatically to not exceed that number. We don't have this feature as a limitation in other bridges. That's one. And two, there is no way for any of the large bridges right now, they don't have, again, a supervisory network, a complementary network that ensures that everything that is happening on that bridge is exactly as it is intended. And the difference here, again, is the fact that this is all reliant on the infrastructure that Chainlink has had for the past 5 to 6 years, Chainlink Dawns. If you look at the amount of transactional value that Chainlink as a one-stop, I would say, adapter solution has enabled, it's more than $8 trillion since Chainlink was incepted. So this is completely different than building on a completely new infrastructure with potentially like innovative features. At the end of the day, what matters is the resilience and the credibility of the underlying infrastructure, which in the case of Chainlink is Chainlink's Dawns.
And on top of that, I would say also network effects, right? We can measure the network effects with the assets under management, as you mentioned, with $8 trillion of transactional value, the number of active users, the growth of the active users on a daily basis, monthly basis, quarterly basis, and yearly basis, and to see whether these adoption and retention rate is sustained over time. But these are the things, of course, that we are tracking very closely in the research team. Another aspect that we want to discuss here, and in that case, it will be with Lina. Lina, tell us more about the market impact of the Ripple case. This is still TBD, but tell us more, the top 3 things that we should be closely looking into when it comes to the Ripple case.
Absolutely. First, I want to say hi. Sorry for not saying hi in the beginning. And I am very happy to share, bless you, Karim, to share the stage with Karim as usual. So I feel thrilled to see Karim talk about Chainlink. He's been famous to be one of its cheerleaders. So let me quickly recap on what happened with Ripple in case any one of you missed it. So on July 13th, a court issued a summary order that isn't conclusive, that basically stated that there is no problem with the XRP token itself, but the issue comes with the sales of this token. The court decided or stated in its order that the programmatic sales of XRP token or the sales of the XRP token on crypto exchanges do not constitute a security. But on the other hand, the institutional sales of the XRP token might constitute. And of course, the court invited both parties for a retrial that is still TBD, as he mentioned. So this is just how things are developing in the court. So I'm not here to talk about reg affairs. I'm here to talk about the ramifications. In the short term or the immediate term, like 2 days after the order was issued, although it was inconclusive, but the market reacted in a very optimistic way, especially, so Bitcoin and Ethereum soared, and they, not to all-time highs, of course, but they reached levels that we haven't seen since summer 2022 for Bitcoin, and Ethereum passed the 2K mark. That is a level that we haven't seen since the Shanghai upgrade this year. But that was a short-lived development because it wasn't a really fundamental development in the case. On the other hand, tokens that were deemed as securities in previous cases by the SEC, like for example, Coinbase and Binance, they soared very highly for the 2 following days. They increased 30% each, more or less, but on average. And that shows how investors were hopeful or they're optimistic that these tokens have reached legal clarity. Of course, this is not the case, but this is how the markets reacted. Some of these tokens recovered, they withstood, and they kept on their rally, like Solana, for example. It's one of the outliers this month. You'll know more about that in the monthly review. So this is the short-term ramifications. For the fundamental long-term ramifications, how can this development, although not inconclusive, how can it really affect how businesses see their projects and their tokenomics and how they finance their projects from the ground up? We can definitely see right now, and it's not something that has not been done before, that entrepreneurs will definitely start rethinking how they raise funds for their projects. Now, let me recap and go back to 2017 with the ICO craze and or frenzy, and how crypto companies were focused on marketing their tokens and extracting that investments or the funds from these token sales, and not neglecting, but not dedicating as much time to the fundamentals of the protocol and the decentralization of the protocol, utility, and all that, which is the underlying product that the token only represents. So this is something that companies tend to fall into. What this Ripple case can do, and we've seen that with Polygon, for example, that announced its architecture 2.0 right in parallel with the developments of the Ripple case. And let me very shortly tell you what happened with Polygon. Polygon is upgrading from Matic to Pol. This is mainly to focus on the governance, how the network embraces its community. So there will be 3 main things for the governance. There will be a council allocated to monitor the improvements, and these improvements will embrace not only Polygon, not only the network of Polygon, but also the projects and protocols built on top of it. And that is mainly to just solidify and make the network more decentralized like they always wanted it to be. And it's just a step forward to accommodate the regulatory expectations that are still not in place, but that the teams are anticipating. So this is what happened with Polygon. This is a trend that we find will proliferate, and it will be like a trend that will stay with us until we know what is in the books, basically. So the companies or entrepreneurs now, like new entrepreneurs, will just focus on the fundamentals, and they will reach out to traditional players in the investments market. So it's not going to be a token first model. It will be more of, let's focus on the fundamentals and reach out to VCs and private equity. And in the meantime, we will build the tokenomics and launch it later in the phase when we have a product that we understand and that the user understands and is confident with. This is not something that hasn't happened before. So what happened with Uniswap back in the day, they actually postponed their token launch for 2 years to build their protocol really well. And therefore will have some substance to the token that it represents. And see where Uniswap is now. Uniswap is the largest decentralized exchange with almost $4 billion in assets under management, and I think $5 billion as in market cap. And that shows you how this approach could actually be beneficial for DeFi.
So the TLDR for what Lina just said is that it's possible, although of course we're going to see and monitor how the court case with Ripple is going to pan out, but when it comes to market impact, it's possible that we could see more and more of these crypto native applications that starts first with a product that people dearly love without a token. And it means that basically the decentralization aspect of the application is going to be also under question. But that's something that we've seen, of course, with Uniswap. That's something that we're going to see as well with other products that people actually dearly love, like, for example, June Analytics. There is a lot of applications that do not have a token or do not need a token until the token becomes essentially the engine of the application. And I think that's a healthy trend that we're going to see down the line for sure. The other thing that we're super excited about as well that we've seen on the back of what Karim and Nina just mentioned is tokenization. So tokenization, especially using public blockchains, is one of the biggest trends that we've seen so far with the Monetary Authority of Singapore or the Central Bank of Singapore, developing some of these solutions on the Polygon network, on top, of course, of some of these other crypto native applications like Aave. And there is more as well to come on that regard. But to wrap up our conversation before we move on to the Q&A session, that's a question for you, Karim. What are the top exciting developments that you've seen out of the FM conference over the past couple of weeks that is tied to our thesis in crypto? So there is Uniswap X, there is Lens, and there is also Solana. So I will let you break it down to us so that we can definitely spend more time on discussing about some of these exciting developments. So let's start with Uniswap first.
Absolutely. Okay, so Uniswap, it's the largest exchange. It's the first application that anyone who is dabbling his toes into DeFi would come across. And essentially what they have just introduced are a set of features that really just work on simplifying the user interface, as well as integrate some of the more advanced features that younger exchanges have implemented. Specifically, I am talking with reference to solutions that address MEV. But let's talk real quick about what Uniswap X offers. First of all, they're going to aggregate liquidity from a variety of sources. So think of it as an aggregator. Rather than just relying on the liquidity and the capital that is available on the Uniswap platform, it can plug and query other capital and liquidity on other protocols. So this is beneficial for the interaction experience with the exchange itself. You also are going to start having gas-free swaps. How are they going to do that? Essentially, in the new model, you have an off-chain and an on-chain component. Off-chain components, these are essentially where when you as a user, you want to exchange from ETH to USDC, you essentially request that price feed off-chain. And it's done this way so that essentially because all of the interactions on-chain require paying gas fees, with that approach, you are able to reduce that amount. In addition, because of the fact that you are outsourcing the market making of that token to the off-chain and on-chain aspects of Uniswap X, when you outsource the fact that you want someone to come and fill in the order for the user, they would also be able to essentially sponsor the user's transaction fees or the user's gas fees. Essentially, since they're already enabling that transaction to take place, they just incur an additional cost, which ultimately, even though it might be an increased cost on them, it does help make the trading experience on Uniswap extremely intuitive and probably as seamless as we see on centralized exchanges. So yeah, these are the two main things. And then most importantly, how they are going to address MEV. MEV, it stands for maximum extractable value, but it's essentially another way to essentially talk about market manipulation, front-running attacks. Rather than you as a protocol sharing the MEV revenue with a different type of validator called an MEV searcher, you essentially give this reward or this yield back to the user through an improved pricing on the asset that he wants to buy in the first place. This is a bit too technical, but again, to avoid getting into the gritty, nitty details of it, essentially, just as a way to recap what Uniswap is doing, it's addressing one of the market manipulation concerns that we have seen across crypto. There are solutions that were implemented by younger exchanges, but no one from the established ones have been able to do it. They're going to introduce gas-free swaps in due time. And finally, they're going to aggregate liquidity sources, which will improve the pricing for users using Uniswap. How is that aligned with our theses? One of the things that we predicted in early 2022 is that the exchange that is going to solve for MEV is probably going to be the winner, at least for the short-term impact, because at the end of the day, you have to remember that most of the newcomers, they don't feel comfortable having their financial transactions being run. This is not something that exists in traditional finance. We have solutions in TradFi like dark pools, but until we reach that level of maturity, these are the kind of solutions that will be implemented in the short term to address it. So that's on Uniswap. In terms of Lens, I'm really just going to give a very brief overview of Lens. Lens, think of it as CCIP. It's not a social media application, but more of a social media standard. So Lens itself, think of it as the underlying stack, and then you have a bunch of applications building on top of it. So the most famous example is Lenster. Lenster, think of it as the equivalent of Twitter on-chain. Now, Lens itself, since it was really a new primitive, social applications have not really took off in crypto, and this was the first big attempt at introducing social activity. So because of that, obviously the protocol had a lot of limitations last year, which they are now hoping to address with their V2 version. It's live right now, but it's limited to just a waitlist. So what are some of the things that they will be able to do? You know how when you are using a website, there is usually a way that you can just share something to Twitter directly because you have some sort of a small widget on your website. Now you do have this capacity. Lens itself as a standalone protocol or a standard, it will now have the capacity to interact with external applications. So think of it as such. You have just posted something on your Twitter equivalent, and now you want to tokenize that instance of what you just wrote to provide the information that validates that you are the owner of this. Now, if you are able to do this, you don't have to go to OpenSea to mint a new NFT. Just on Lens, because of the fact that it is now able to interact with external applications, you would have this just as a really simple feature. Another thing is that your NFT or your account, it is now a little bit smarter. So we can tie this a little bit to account abstraction, which we started the call with. When you have a profile, that profile, so think of Sandbox, just the two largest metaverse games. Your player or your character in that game, if you give it a set of predefined conditions, it can now interact with other players or with other entities or with other on-chain components without you having to manually execute that. This obviously creates a new level of complexity for social applications that we can't even think of how this can be resembled in the traditional Web2 landscape. So that's in terms of Lens. And then finally, just to give our readers and our listeners a chance to ask any questions, Solana. So as we all know, Solana has been struggling for quite some time now. It started the year, the very rough start due to the issues with FTX. And then more recently, due to the inclusion in the case of the SEC against Coinbase and against Binance. As Lena has thankfully mentioned a few minutes ago, there were a list of tokens that were deemed securities, and Solana was unfortunately one of them. We're not talking again here about the regulatory practices, we're just recapping the facts. So with Solana, there was a migration of developers. The assets under management was declining quite progressively over the past year, and it just felt like this was the end of Solana. However, I'm happy to share that this is really not the reality of it. mainly for two reasons. One, we've already mentioned this earlier in the call, there is a general tendency of competing Ethereum competitors to now build more bridges with Ethereum in order to benefit from, again, its liquidity, its network effects, high number of active users. So in the ETHCC conference, we saw that there are now 3 distinctive solutions that will help shorten the gap between Solana and Ethereum. There is something called Neon EVM. So with Neon EVM, you essentially have, think of it when you have Windows and Mac. When you want to expand your Windows application to a Macintosh application, you can't really do that. You would need to recreate the application from the ground up. However, with Neon EVM, you are essentially creating a cross-compatible standard for your applications. So the smart contract that lives on Ethereum will now be compatible with the Solana ecosystem and vice versa. So that's one. Two, you have something called Solang. So as we've also mentioned earlier, Ethereum has its own programming language and Solana has its own programming language. However, with Solang, you now have a compiler, or in simpler terms, a translator, something that takes your Solidity code and then modifies it and readjusts it so that essentially it is working on the logic of Solana's language, making essentially the deployment of some of your application as seamless as just changing a few minor parameters without having to rebuild the whole thing from the ground. And most importantly, Solana had a lot of blockchain outages. This was more so last year and the year before. I think they've had more than 15 outages, which is really not something that a blockchain can afford, because at the end of the day, it's all about liveness and about the fact that there is data availability at any time. So with Solana, there is now Jump Crypto, one of the most established and trusted crypto companies. They are now developing something called the Fire Dancer Validator Client, which is essentially, think of it, and just to simplify this, when you, as a Bitcoin miner or as an Ethereum validator, you just run a software on your computer that essentially plugs into the network, broadcasts the information that is coming out of your computer, and retrieves the reward based on your activity. And going back to Solana, if you have more than one node client software, if one software experiences any issues, either due to cybersecurity or outages or whatever it may be, the blockchain itself does not come down to a halt because you have more than one software. And this is, ultimately speaking, a crucial aspect, because this is how nodes communicate information to the network and vice versa. If this route does not exist, then you essentially have an unusable blockchain. And I'm going to contain my excitement and just leave things here just to avoid going beyond that.
And we definitely don't want to spoil the upcoming research note that you guys are going to publish in the next few hours. So I want to thank you guys, Lina and Kareem, for the great insights, but also for the audience for your time. We know that we're almost at time, so thank you so much for attending. We hope you like the session. If you have any feedback, comments, please feel free to reach out to us at research@21shares.com. But of course, stay tuned for the up and coming newsletter, because there is a lot to unpack for the past month. But thank you so much, everyone, and we wish you a wonderful day. Thank you, guys.
Thank you, Ali.
Bye-bye.